Einhorn is the president of Greenlight Capital, joining us now on the phone. David, great to have you with us.
Great to be here. Good morning.
Good morning. And, I know you were watching the testimonies yesterday with great interest. You said that they were damning. What was most damning about this?
I think there's two basic issues that are kind of confused. One is there's a basic, unchallenged view that the ratings are a public good. In fact, I think that the ratings are a public bad. It's very risky to have your business or you're dependent on just like a single customer, like if you sell all your product to Walmart. And it's similarly dangerous to have your credit determined by one or two centralized official committees. When you run into trouble, it's much better to be able to go to the entire market to prove your creditworthiness and to try to borrow money as you need to. And so having this centralized decision making is really a very big problem.
And yet, David, there appeared to be this belief among Buffett and others that there really is no alternative to the current system. Is there really an alternative?
Well, it reminds me a lot like when my parents told me when we were 7 that we were moving to Wisconsin, and I didn't know what would happen. Would I make new friends? Would I have a new school? How would this all work out? And I was very upset at the time. But we moved, and it kind of worked out okay. I mean, the idea that if we didn't have ratings, official ratings, something bad would happen, I don't think makes that much sense. It's not like Morgan Stanley and Bank of America are going to say, well, we can't underwrite bonds anymore. And it's not like bond buyers would say, well, we can't buy bonds anymore. Basically, we would just have a new way of going about it. Right now, we do IPOs for stocks. There's no official ratings for the stocks before the IPOs get done. The market would adjust if we didn't have official ratings.
Well, I mean, in your best view, and I like your example of sort of striking it on your own. I mean, if some companies or issuers were to strike it on their own, what would they find, though, David?
Well, right now we still have the system of official ratings. So they're sort of locked into it because everybody does it. So what we really need is a sort of a systemic change to just reject the idea of having centralized official ratings, and then the market would adjust, and it would be the same adjustment for everybody, so nobody would have to be striking out on their own.
Okay. Getting back to Buffett, though, David, were you surprised by his reasonings for backing Moody's?
Well, I think it's really very much to his credit. When he identified Moody's a decade ago, look at the competitive position that the company had. And I think he made a fine investment. It did well for a long time. Even with everything that they've done, I think, to sort of ruin their brand, I think he still made a very nice investment for himself. I think from here, the risk-reward in the stock is still pretty negative, and so we're on the other side. But I do understand what his thinking was.
But how much, and I know that you yourself you've made a pretty nice investment so far in shorting Moody's and also McGraw-Hill, which owns S&P. I mean, how much further do you think those stocks have to go down?
Well, I think that they're lousy investments for a few reasons. I think, first of all, that their brands are ruined. And yes, one thing that came clear in the hearing was they basically had the attitude that our market position is so bad that no matter how poorly we perform and how badly we behave, that our market position will be preserved. But I don't really think that that's true. I think that the brands are ruined. I think that Congress is already putting in laws that will make it much harder for them to recover towards their former level of profitability. I think just yesterday, Europe announced that they're going to regulate the rating agencies, basically with a view, I think, to getting rid of the U.S. credit rating oligopoly, at least reflecting European credits.
Right.
And ultimately, these guys face enormous legal liability through a whole variety of lawsuits, where if they ultimately lose even a single one and have to pay off any bondholders, given their capital structures, particularly Moody's, which has a fair amount of debt, equity holders won't do very well.
And David, did you find, and I was going to ask you about that European model, but did you find, though, that what the Moody's executives and former executives were saying was going on at the company, did you find that that also is happening at Fitch and at S&P? This whole idea of understaffing and, the pricing problems.
Right. Well, when you look at the margins that their credit ratings had during the boom, it was pretty clear that they were charging a lot of money and not doing very much work. And there's a lot of evidence that these guys were very focused on their market share, and they allowed their quest for market share and for profits to compromise their ratings objectivity. And that's what for example, some of the legal challenges are about.
But short of what you're proposing, David, which is essentially to phase these guys out from the system. I mean, if we were to, for instance, raise the amount of staff at these companies, if we were to change the pricing model, wouldn't that in some ways be the answer to this?
No, because the problem isn't just having better ratings. That's what they want you to discuss. Can we have better ratings? But ratings are, by definition, impossible to measure. Credit analysis is a probabilistic thing, right? And if I told you, that there's, a 50% chance that you're going to get red the next time you play roulette, and then it turns out that it was black, I didn't give you bad advice. The percentages were what they were, and the future is uncertain. So you can't measure credit ratings based upon what subsequently happens, given all the uncertainty that's out there. What we need instead of better ratings is we need to get rid of having official ratings so that the market can judge risks for itself. And the people, incidentally, I should add, the people who say that they don't use the ratings, they actually use them a lot.